So, just a matter of interest, what we wanted to do was actually come to an actual example here. Now, I don't understand the terminology, you call it a buy and flip, I think?
Gosh, no, fix and flip.
Fix and flip.
You fix it and then you flip it, you aren't sell it, as opposed to a buy and hold.
No, fantastic. So, and I mean, this is a great example. We arrived here, the realty agent was actually outside this house. I don't know if you see behind Brennan there, is actually for sale. Now, interesting enough, 3 months ago, this house was bought for $285. It's been fixed, renovated to use your terminology. It's currently on the market for $550. Now, the realtor said he's probably, you know, it's probably too much. It probably should be about $475. But interesting enough, he also said, which for me as an investor is very interesting, there's very little stock on the market. And his exact words were, the investor might get lucky, because in this it's a good area, and he said there's very little stock at the moment. And so, but you know, with all due respect, if you're buying something for $285, even if you're selling it for $475, it's proper, you know, it's a proper investment.
He would have had a cost component to renovate it, and we don't know what's been done, but even if there's $100,000 for that, and it was what, 2 months ago?
Yep.
I mean, that's still $100,000 profit, US dollars, in a couple of months. That's not bad.
Yeah, but importantly, it's not like there's 6 on this block.
Right. No.
You know, as you said, you could get lucky because there's so little stock in the area, basically.
And that's where things have changed, because a year ago you'd come down a street like this and there'd be for sale signs everywhere. So it's a dramatic turnaround. The amount of stock that's available on the market has shrunk totally.
Tell us, Dolf, just, you know, with all your experience, and again, we know we're standing outside at just an average American home, and you don't know all the exact details. But with the psychology of investing, what would you do? You would arrive here, you know, what would you look for? Were the schools, the areas? Like, what would get you the green light to actually start doing a proper due diligence on a property?
You know, it's a funny question, because I've kind of done that already, and here's the way I see it. And one of the benefits, of course, if you come participate in one of the trips we might have on offer, is you get the benefit of my, I guess, decades of research in this. But I would look at which sector of the market do I want to be in. Do I want to be in the $50,000 and below market? Now, it's true that if you buy a home for $40,000, that's a pretty good deal. And even if the rental's cheap compared with a fancy home, you're likely to be cash flow positive. But you're also likely to attract a different kind of tenant, one that won't be there as long as you'd like, one that if they put a fist through a wall, they think that's normal human activity and all that sort of thing. And then they call you and get you to fix it. You know, they say, hey, the drains are blocked, and you say, well, what on earth are you putting in? This is the 3rd time this month that you've blocked the drain. And they say, none of your stinking business, come and fix it. So do you want tenants like that? So there's 50,000 below, there's 50 to 100,000, there's 100,000 to $250,000. Right now, the best sector in this Phoenix market, the sweet spot for finding great deals, is the $1 million to $2 million range. And you might say, whoa, that's way beyond my price range. Well, before you think that, here's a thought. Why not bandy together with 5 or 10 other people who on their own might have all bought not so good $100,000 properties, and instead of each owning one $100,000 property, you could bandy together and buy $1 million property that has a much greater discount to value. And you've only got one tenant to deal with, you've only got one property, one set of toilets that have to be unblocked and all that sort of thing. But right now, that is where the best value is. So it's just a thought. You've got to think outside of the box. You don't have to think in terms of what could I buy with my cash resources, could I bandy together with other people? That's just a thought.
And just on that topic, how difficult is it to bandy together with other people? Talking logistics.
Logistically, it's very simple. You just need to have some kind of a memorandum of understanding how it works. You can make it formal. You can do it in the form of a company. You can do it in the form of an LLC. You can do it as tenants in common, although I would not recommend that. But it's no more difficult than doing one on your own. You've just got to, you know, understand that you're now in a partnership with other people.
Look, I think one of the things that we're wanting to do in our trip is actually facilitate that. Because, you know, it's not that difficult. You create an LLC, you come up with a shareholders agreement, whatever you want to call it. But actually, the problem is you've got to know the people you're investing with. That's the biggest challenge. And one of the things that we want to do from our trip is introduce you to like-minded investors.
Well, it's what invariably happens anyway. I'll never forget, I did an event, and there was a woman there who told us that she'd been given a house free of charge. The only thing is she had to remove it from the existing property, and she thought it was a great gift, but she just didn't know what to do with it because she didn't have the money to buy any land. And then about a couple of hours later, ironically was another woman, but she came to me and said she'd just been bequeathed this piece of land, but it was costing her property taxes, and she didn't know what to do with it because it was costing her money. So you're smart and you're fast, you've already put the two and two together. I introduced those two women to each other, and the one with land offered the land to the one with the house. They put the house on the land, and they both shared in the profits. They would not have met had they not gone to that event. They would not have thought of running an ad to find someone like that. So you'll always find people at events you go to who are like-minded. The fact that they're like-minded is the fact that they even turned up an event that you turned up at. So you'll be surprised how much synergy there is between people who turn up at an event. That's why we're not even going to promote doing, you know, this formal communal ownership or syndicate or whatever. It's going to happen anyway. You're going to say, well, we could each buy one of these not so good things, or together we could buy one of these really spectacular things. And by the way, by spectacular, I don't mean what it looks like from the outside. I mean whether financially it's a great deal or not.
Two questions quickly. You've traveled the world. You've been around the world 100 different times. I think you said the other night at the presentation we went to. The world's going global. Tell us a little bit about what your thoughts are. You know, 10 years ago, property was very much a case of I lived in Phoenix, I bought a house in Phoenix. I lived in Johannesburg, I bought a house in Johannesburg. And with the advent of the internet and access to information and cheap flights and all that sort of stuff, it's going global. You know, the bottom line is people are interested in returns in different areas. You know, you can get a far better, possibly a far better deal here, better yield, etc. So now suddenly, well, should I invest in Joburg? Should I invest here? Well, it actually comes down to the numbers.
It does come down to the numbers. If you live in Joburg, I would say get your first investment property in Joburg. Probably get your second one there. You've got to cut your teeth on it. You've got to learn the ropes. You've got to learn what it takes to be a good investor. But if you've got 10 properties in Joburg and you're looking at buying an 11th, I for one would say don't buy it in Joburg. Buy it in Cape Town. Go to Port Elizabeth. Go to Durban. Go to anywhere else. And once you've got a few more, I would even say it's time to think about going global. And you South Africans know the answer to this better than most nationals of any country, because you've suffered from the ravages of what can happen to the rand. And I'm from New Zealand originally. We had it there too. We had exchange rate controls. If you left the country, it might still be the law. If you left the country for more than 13 weeks, they stopped your social security payments and your pension and stuff, because they didn't want anyone, heaven forbid, to spend their New Zealand dollars overseas. So you need to spread your risk a bit, and if you're going to spread your risk, why put it into a market where the currency is going down, where the population's in decline, and where there's no growth? You are far better off investing in places where there is great growth. And I always say it is so easy to beat the average. The average growth rate long term in this country for real estate is about 9.7%. But don't settle for 9.7, that's the average. That includes little cities that have shut down because they used to have a steel plant or a coal mining plant and they've shut down. They might have negative growth, so the 9.7 is the average. That means there are other places that have high growth. That's why, as we said before today, if you invest in Las Vegas or Phoenix, you will beat the national average by a wide margin just by picking those cities. So let's say we're talking about Phoenix. You don't even have to pick a house at random here, because there are suburbs that for decades have grown at faster than the average rate, and other suburbs that grow at less than the average rate, and these stats are easy to come by. You compare that to stocks or shares or whatever you call them. It's very hard to pick something, a market sector that has higher than average growth. They used to say it was the technology stocks, and then we had the technology crash, and then they said it was bio whatever, and then that crashed. It's very hard to pick, and it doesn't tend to have those trends for a long term, but real estate trends stick around for a long time. So yes, invest overseas to hedge your bets, and if you're going to invest overseas, why not pick a fast growing market like Phoenix or Las Vegas?
Last question, sorry Neale, just the last question from my side was new developments versus existing stuff. You've spoken a bit about replacement value. You know, there are, in South Africa, people are talking about new developments, but yet we've come over here, we've spent a lot of time researching the market. We're not seeing any new developments, and one of the things is because of what you explained with replacement value. It doesn't make any sense when there's an oversupply already, you know?
Right. No one's building at the moment, because right now you can buy stock, you can buy housing and commercial buildings for less than the combined cost of the land and the building materials and the labor to put it all together. So that means there have been few building permits issued, nothing's been built. The population's still been going up. How's that possible? How can the population be increasing and no new houses being built? Well, people are living with their in-laws and probably their outlaws and all that. They've got more people per home and all that. They're getting married, but they're still staying at home before they venture out on their own. So there's pent-up demand or latent demand. The bubble's going to burst at some stage, and there's going to be a big, huge increase in building permits issued and houses being built. But in the meantime, it is cheaper to buy existing stock than to build something new. So, you know, I wouldn't venture there. I don't know why anyone would consider building right now when existing stock is so cheap, but it's all going to turn around.
But on that note, I mean, there's schemes out there where you can get an EB5, and which is effectively a green card, because you're helping a developer build a development in an area that has no growth, and they're trying to provide jobs.
That's true. You can get an EB5 that way, but you can get an EB5 visa also by investing in a business or just by investing in existing real estate. So you don't have to buy into a development to get the visa. You can buy existing stock if that is your business.
What would be your thoughts on, I mean, just from my gut feel, buying into development stuff at the moment is almost suicide in comparison when you've got replacement replacement value stuff?
Yeah, it all depends on the market. The cycle will turn around again, and one day I'll be saying to you, you know, right now it's a great deal on developer stock because they're offering it at a 40% discount relative to what they'll sell them for when they finish the project. But no, there's hardly anything being built, and there are no incentive deals because people are picking up stock elsewhere. It's not where I'd put my capital right now. But that'll change.
We're talking about running the numbers, Dolf.
Yes.
I know you've got software, and I know the investors out there are going to get access to this, because I think it's very important. You're coming into a different country, you need to, with US dollars, you've got utilities, you've got deposits. That's going to be accessible for them? And
yes.
And just expand on the running the numbers in the context of that software?
Well, I'm a numbers person. I like to know the numbers. The worst thing that I think people do is they say, I'm going to buy that house, and you'll say, why? And say, well, it's just really cute. Or the neighbor's dog is cute. Or even worse, the neighbor is cute. Wrong reason, you know. The numbers have to work. And most people work out the numbers on the back of an envelope or something. It's the wrong way to do it too. So we have software, it's called Real Estate Acquisition Program, that we'll make available to everyone coming on our trips, where you can analyze everything. Not only what are the rentals, but what are the vacancy rates in this area, and all those factors. There are about 60 different inputs that you can put in. Most of them are standard for a particular region you're looking at. By the way, you can select which country you're in, whether it's South Africa or America or Australia or France or wherever, and the currency and all that, and it does the analysis, so you can compare how good an investment in Johannesburg is, say, versus one in Las Vegas or anywhere else in the world for that matter. That's really useful. The numbers don't lie. You know, I'm a numbers person. It boils down to, is it a good deal? Basically means, do the numbers work? And people blind themselves by emotion. You cannot buy on emotion. It's fine to use emotion if you're wanting to buy a house to live in, but when it comes to an investment property, you've got to leave your emotion at the door. It's not whether you love the house, it's whether you love the deal. That's what it boils down to, and we facilitate that with the software.
Can I ask one question? A lot of people feel going global is all fair and well, but they're scared to be far away from their investment in case something goes wrong.
Fair van jou goed na in die skade.
Exactly, yeah. We have a saying. But we actually have a cliche like that because of the fear that people have of being far away from their money or their asset or their investment. How do you deal with management down here?
You know, it pays property managers on residential property anyway, and they're good. I mean, when there's a big enough pool of rental properties in a city, you have great management companies with great competition between them. So if that's your concern, you're focused on the wrong side of the market. I'd rather have some hiccups with my management team on properties that have good capital growth of 15% a year on average than have perfect management because it's in my hometown, but they're going down in value by 1.5% a year. You know, if you manage all your own properties, how many properties can you own? 20, 30? It's full-time by then, and you'll never buy another one because you're full-time managing what you've got. You've got to farm out the management, otherwise you're going to be stuck into small thinking.
Cool. Thank you very much.
Thanks very much.
Thank you.
Awesome.
All
Thank
right.
you.